So in the last class we mentioned that one of the easiest things to measure or relate to is standalone risk, and generally standalone risk has a very high correlation with, say, corporate risk or even market risk. So the rest of this segment is going to focus on standalone risk, so at least you understand it. The next question then becomes, what are the different ways of measuring standalone risk? And the answer is, at least from what you need to know right now, there are three broad mechanisms. One is called sensitivity analysis, two scenario analysis, and three Monte Carlo simulations. Okay, have you seen these terms before? Okay. Okay, so these are different techniques for measuring standalone risk. Let's talk about sensitivity analysis. Sensitivity analysis measures the effect of changes in a variable on a project's NPV. So, Manoj, what were the different variables that went into calculating the NPV of our project? Yeah, so things like cash flows and discount rate, and then those those were in essence the variables that you calculated. From the perspective of a marketing person, what you might say is the variables are things like sales. Will sales be higher than expected, lower than expected? Will variable costs be higher than expected, lower than expected? Fixed costs, the price at which you can sell. What's the difference between sales and price? So sales might be the number of units that you are selling. Do you remember the main example that we started this chapter with? The example where we were selling a certain number of units for $3 each. Variable cost was $2.10. Okay, now all those were inputs. Are you sure that you'll be able to sell every unit for $3? No, so maybe the price is higher. If economic conditions allow you to charge a higher price, will you do that? Yeah. Probably. If people are not buying at 3, then what will you do? Then you will effectively have to reduce the price. So those are all variables. What sensitivity analysis says is you vary one variable at a time and then figure out what's the impact on NPV. So just qualitatively speaking, if you can tell, or if economic conditions are good and you can sell for more than $3 a unit, what impact will that have on the NPV? It will be positive. So do you get the point? In sensitivity analysis, we just take one variable at a time. Okay, so let's do that. So to perform a sensitivity analysis, all variables are fixed at their expected values except for the variable in question, which is allowed to fluctuate. Okay, and then we look at the impact on NPV. So let's look at what's going on here. I'll just refresh your memory. The example that we talked about earlier, that we made assumptions about lots of stuff. Do you recall those assumptions? Yeah, we assumed a certain constant sales, we assumed certain inflation, we assumed a certain tax rate, we assumed a certain selling price, assumed certain costs, and then do you recall what NPV we got? Yeah, it was actually this number. So nothing wrong with not remembering this. So given the assumptions that we made, we had a NPV of this number. And actually, just to refresh your memory, I'm going to very briefly show that. So these were the sorts of assumptions that we made, and then we did this whole calculation, and we came up with a NPV of 5809 and positive NPV, a good IRR, so we went forward. Now what are we doing? What we are saying is that we want to do a sensitivity analysis. So one variable that might be different from what we have assumed is sales price. Right? What was the sales price we had assumed in the base case? We had assumed $3 in our calculation. Is it possible that sales price turns out to be 15% more than what we had anticipated? Okay, so we take the base case is what we had assumed. So if we assume a deviation, what if sales price is 15% higher? What will happen to the NPV, Shahama? 15% higher than the $3 that we had anticipated. Yeah, so the NPV then, so what this table is giving you is the NPV if sales price is 15% more than $3 and all other variables stay the same. Okay, and what do you think this number represents, Saira? Exactly. So if the sales price is 30% less than what you had anticipated, then the NPV is minus 27 to, well, if you want, you can do a more granular analysis where you can say 1% change, 2% change. This is just illustration of the concept. But is there anything stopping you from having a deviation of plus 1%, plus 2%, plus all the way up to 40 or whatever? Not, can you do the calculation? So if I ask you, what will the NPV be if the sales price is 2% different from what you had expected? You can easily just solve on Excel, and hopefully by now you are reasonably good at Excel. Okay, so that is a great point, and this is actually one of the criticisms of the sensitivity analysis. Okay, so the comment was that even if, so normally only one thing doesn't change, multiple variables change simultaneously. Okay, so that point I will get to. Right now, with most things that you study, and this is a general, I'm making a general point now. In finance and in many other disciplines, you study techniques. There is no technique that is perfect. Okay, so an important part of your learning experience is to understand the technique, understand what's good about it, and understand the limitations of that technique. So what you articulated very well is one limitation of sensitivity analysis, but limitations will come later. Right now we need to understand what is sensitivity analysis. Okay, now to see whether you've understood, so that's Manal. Okay, Manal, what is the interpretation of this number? How would we get to an NPV of 21556? Next to Manal is Sabah. So what's the interpretation of this number? Do you recall what was our growth rate assumption before? Actually, our growth rate in sales was 0. Actually, let me just make it slightly easier then. So, Manal, you have another shot. What's the interpretation of this? Actually, let's start easier. What's the interpretation of this number? Where do we get this number 29404 from? How did we get this? So 29404 is the variable cost. Which price? Do you remember what our base case was for variable cost? Anybody remembers what our base case, how much was our variable cost? The selling price 2.1. Exactly. The base price for variable cost was 2.1. So how do we get, what is 29404? Under what circumstances? Yeah, so just Zara, can you just, I think she's on the right track. Can you make a proper statement now explaining where 29404 comes from? Exactly. So 29404 is the NPV of the project if the variable cost is 30% less than our base case. Does it make sense that the NPV shoots up if your variable cost is much lower than you had anticipated? Okay. So now next to Zarak is Manoj. Manoj, what's the interpretation of this number now? 17785. Excellent. Okay, so you are with the program now. Okay, good. So if the cost turns out to be 30% more than 2.1, then we have a NPV of minus 17785, which is what you would expect. Does everybody understand all these now, where all these numbers come from? Okay, so Turab, what's the interpretation of this number? Then we get, so this is what? This is a fixed cost number or a NPV number? The NPV of fixed cost. The NPV of fixed cost. Can you explain that? What does NPV of fixed cost mean? NPV of what? So can you explain to Turab what was wrong with his statement? What was wrong with Turab? Actually, somebody from far away, so everybody else can hear. So who wants to? So can you explain to Turab what was wrong with what he just said? Explain to him. Okay, Abu Turab can explain to Turab.
Okay.
अब बात समझ में आई कि नहीं? Okay, अगर समझ में आई then explain this number to me. 9030. What is this number and how do we get it? Zara, you just open your mouth and speak a little more clearly. Here is 5809. Right now I'm asking you the interpretation of, and what is this? Is this a WAC number or what is this number? Is it a cost? Is it a cash flow? Excellent. So it's the NPV of the project if WAC turns out to be 30% less. Why is it that when some variables are such that when they go down the NPV goes up, whereas there are other variables where when NPV, so when the variable goes down, sales price, so here NPV is going down but here NPV is going up. Next to Turab is for Hassan. Yeah, I think you, so Saad, yeah, I think you understand it, just need to work on the, how to explain. Yeah. No, the core, let me just make sure so everybody is on the same page. So what's going on here is a given number that you see, such as this number 9030, we are saying that only, remember we are doing sensitivity analysis. In sensitivity analysis only one variable changes. Okay, so 9030 means that I don't recall what our assumption about WAC was. I think it was, let's say WAC was 10%. Okay, so what this number is an NPV if the WAC is down by 30%. So instead of 10%, the WAC ends up being 7%, and all other variables stay the same. Then the NPV of the project will be 9030. And obviously, if the WAC that we are using is lower than what we had initially assumed, is that going to create a higher NPV? Yeah, because a lower WAC is going to give us a higher value. A lower cost is going to give us a higher value. A lower sales price or a lower number of units sold is going to give us a lower value. Okay, what does this tell us? Stare at it and then I'm going to ask questions on this. But I just want everybody to realize this. Yes. So the question is what's the growth rate? So we had assumed that the growth rate is 0. Yeah. So this is saying that if instead of 0 growth rate we have a 15% growth rate. That, remember we said that the number of units sold is I don't know, it was 2,000 or 3,000 or 20,000 per year. So if instead of 20,000 per year we assume that
50% more or less.
Yeah, every year the sales are increasing. Is that an unreasonable assumption? No, it's reasonable to see what happens if my growth rate, if my sales keep growing. So here you will notice a positive relationship in the growth rate and quite sensitive to growth rates. Actually, what do you think these numbers mean? What is this 66064? Yeah, the range. Yeah, the range is the difference between the highest and the lowest. Okay, so somebody who I have not picked. So your name? Yeah, Rizal. What are we looking at here? So looking at this graphical representation, what variable is NPV most sensitive to? Yeah, so the two variables that NPV seems most sensitive to are sales price. So what does this mean? This means that for let's say a 15% increase in the sales price, the NPV increases a lot, and similarly for a 15% increase in variable cost, the NPV would go down a lot. So the more the slope of this line, the more sensitive the NPV is to that variable. Alright, does that make sense?
Yes.
Okay, and I hope that it is obvious why certain slopes are positive and certain slopes are negative. Yeah, we could do that too.
That's a possibility.
Yeah, actually a general point, another difference between accountants and financial analysts, accountants have to follow certain strict rules. Financial analysts, you can do 500 different kinds of analysis. Okay, there are no hard and fast rules, so you could do whatever you want, as long as you can then go convince people that what you have done is good. Okay, so there is a balance between doing things that are too complicated and doing things that are too simplistic. So it's much harder being a financial analyst because you have many more tools to work with and many more ways of presenting information. So what are the advantages and disadvantages of sensitivity analysis? So next to Ghazal is Salman. What are some advantages of sensitivity analysis? Yeah, so just taking that one step further, it tells us what variables have the biggest impact on NPV. And how next to Salman is? Samir. So how is that useful? So now you know that what are, based on the analysis you just saw, which variables NPV was most sensitive to what variables? And sales price. So now when you are designing your project or thinking about stuff, what variables would you be most concerned about? Yeah, so once you understand that, okay, my NPV is heavily dependent on these variables, then you would try to do whatever possible to make sure that those variables are not negatively impacted. What do you think are some disadvantages? Well, we've not talked about this, so it won't be in your notes. But anyway, yeah, so one big variable is that it just takes one variable changing at a time. But when things go bad, economy goes south, you have a recession, does only one variable change or multiple variables change? Multiple variables change. Okay, so that's not explicitly written on this slide, but that's a major issue with sensitivity analysis, that typically only one variable doesn't change at a time. Then the other bullets are somewhat self-evident. So this analysis or measurement of risk does not tell us about the benefit or diversification. Okay, it does not incorporate any information about the possible magnitudes of forecast errors. So what we mean by that is, in this sensitivity analysis, we are just looking at the sensitivity of NPV to changes in a given variable, but this method does not allow us to think about what the change in a given variable actually will be. Okay, you'll understand this better once we do scenario analysis. So for example, if you do believe that sales price might actually be quite variable, okay, this analysis that we just did was allowing you to put all the data out about every single variable and look at the sensitivity of NPV to that variable. Doesn't go beyond that. Okay, now diversification with respect to other projects in the company. Actually, so that is the whole point, is it's only telling us about standalone risk. So that is the criticism. Okay, so now another method which is actually used more often is scenario analysis, where this type of analysis brings in the probabilities of changes in the key variables, and it allows us to change more than one variable at a time. So for example, is it possible that you actually have some probabilities associated with economy being better than expected, worse than expected, and so on? Yeah, so this part which sensitivity analysis did not do. So now we can build in what's the probability that the economy is worse than expected, what's the probability that economy is better than expected. Okay, so that's one element. Another element is that you can assume in a best case scenario, for example, that multiple variables change. So in a best case scenario to which you are giving a probability of 25%, you might say that in the best case scenario the sales price will be 390. The unit sales will be more than what you had anticipated. So original anticipation was 20,000, but if the economy is really good, then you will sell more, variable costs less, and you have a high growth rate. Okay, so notice multiple things are happening here. One is you can give a probability to that scenario, which we did not do in pure sensitivity analysis. The other is we are saying multiple variables are changing. Now this is just a simplistic example. When you go into the workforce, you can do a more rigorous version of this, and in general it is smart with any project to do a scenario analysis. So you look at best case, worst case, average case. So at least you should do 3 cases. So this is just a made up academic example to show that it's too good to be true. So when you do this, you will be smarter about it. Over here you are just learning the mechanics of the process. Okay, so somebody has taken a way too good scenario over here. So this is straight out of your book. Maybe you can assume that even in the best case scenario, even the costs of production will go up. So is it hard for you to change those numbers and come up with another NPV? Now you're smart enough to do that. Okay, so all the book has shown is that under this, maybe overly optimistic scenario, the NPV is huge. Okay, so this is the NPV if the scenario is really, really good. What's the base case scenario? Yeah, this is what we did initially. So this is the base case scenario. What's the worst case scenario? Yeah, so you have a terrible situation. So what happens in this scenario? Sales price is low, unit sales are low, growth rate is negative, so everything goes bad, and you have a. So at this stage, don't worry about this. This is the squared deviation times probability. So we are actually coming up with the standard deviation of these numbers. So just hold off on that for a second. So that, remember one thing I said early on in this course, that most of what we talk about, so there is this finance is 80% art and 20% science.
The art part.
No, what we are talking is the science part. Coming up with the probabilities is partly the art, where how do you figure out sitting here whether the economy is going to do well or not? If it was teachable, then everybody would just know what's going to happen, right? So there are some variables that you look at, and the people who do well are the ones who are best at predicting what will happen. Okay, so if you're good at predicting, then you should go do it rather than teach it. Okay, that was also the art part, in the sense that you based on your wisdom and your knowledge of the market and your how well you forecast, you say that okay, if the market is performing really well, then it's your judgment in a really good scenario, how much will you sell the product for? Okay, so the point is this: at this stage, what we are doing is we are saying there are different scenarios, and under those scenarios we have a different NPV. So what this analysis allows us to do you think if in different scenarios the range of NPV is very high, then does that mean the project is risky or less risky? Risky. So the way you can look at this is as follows. If you create multiple scenarios and you notice that in the multiple scenarios the NPVs that you are getting are all over the place. Okay, that means that there is probably that means that there is a lot of risk. So what happens in this project? You have, in your base case, you have an NPV of about 5,800. If things go well, you have a hugely positive NPV. If things don't go well, you have a pretty substantially large, pretty negative NPV. So overall, it's still a positive NPV project. But if somebody were to tell you that if this project fails, then you'll be fired, okay, that would make you fairly risk averse. Okay, what would you do this project or not? Probably not, because that means there is approximately a 25% chance of your being fired, right? Which, when you put it in those terms, it might not be such a good idea. Okay, so anyway, the larger point here is that if there is a lot of variability in your possible NPVs, that means that the project is risky, and if most of your NPVs are falling within a narrow range, then what can you say about the project? Then it is a less risky project. Okay. The next item that we'll talk about, so we've talked now, again, we are not getting overly detailed, you are just getting the core points. You've understood sensitivity analysis, you've understood scenario analysis. Next, let's talk about Monte Carlo simulation. So this is actually one of the most commonly used simulations in the world, at least in the developed world. It is very, very statistical, and it is very computationally intensive. So I'll just read this stuff to you and give you a basic explanation, and then there are a couple of problems in the book that I want you to do. So a risk analysis technique in which probable future events are estimated on a computer, generating estimated rates of return and risk indices. It utilizes the maths of casino gambling, which is where the name Monte Carlo comes from. Simulation software packages are often add-ons to spreadsheet programs, and the website for this book actually gives you an add-on to Excel that allows you to do Monte Carlo simulation. Okay, let me just give you a brief explanation now in terms of what exactly this means. The idea is this, that you have your sophisticated computer program, which is your Monte Carlo simulation. One way of dealing with this situation is you have several inputs. In the project that we just talked about, what were the inputs? Variable cost, sales price, etc., etc. Now, one of the questions that came up is, what will the sales price be? We don't know. Okay, we can make an estimate. So, can we say that the sales price, we expect the value to be $3, but we will model the sales price as a normal distribution with an expected value of 3, but a certain variation. So can we model the future sales price as a normal distribution around $3? If we are uncertain about what the sales price will be, and that uncertainty is relatively high, what will that do to the standard deviation of this normal distribution? It will make it wide, and if we are reasonably confident that the sales price will be just around 3, then the standard deviation can be low. So can we tell our computer program that, look, sales price is represented by a normal distribution with expected value of 3 and standard deviation of 2.7, or whatever it is that we feel appropriate. Okay. Similarly, all other variables can be fed to the computer. We can give the computer a probability distribution, and hopefully you've studied probability distributions in statistics. So the most common one is a normal distribution, but some others might be, continuous distribution. So every variable you can think about what is an appropriate distribution that describes that input variable. So we feed all this to the computer. Then the computer runs millions of simulations. Okay, that's what computers do well. Okay, so computer takes one scenario or one simulation. It takes one particular value of a selling price, a particular value of a cost, and the value that the computer picks is based on the probability distribution that you are telling the computer. Okay, so scenario 1, it picks a certain sales price, a certain cost, a certain WACC, etc., and it spits out a what? What does it give us? What's the result? It will give you a certain NPV. So imagine the computer does this exercise 1,000,000 times. So it will have 1,000,000 NPVs. So rather than giving you 1,000,000 NPVs, the computer is going to give you a distribution of NPVs. Now, if the distribution of NPVs is narrow, what does that tell you? That's a relatively low risk. If the distribution of NPV is something like this, then it is high risk. So the beauty of this method, and the reason it is used a lot in finance, and it's actually used across, it's used in physics, it's used in engineering, it's used all over the place, is that it allows you to use statistics and the computing power of a computer to come up with predictions about what will happen in the future, because this computer is simply like running through millions of iterations and trying to consider every possible strategy, every possible scenario. Okay, so this is Monte Carlo. There is one question in the book that's built around this, so I want you to try that. Okay. The last thing that we'll study in this reading is the use of decision trees. So now this is something separate. Decision trees allow managers to evaluate projects where expenditures have to be made, do not have to be made all at once, but in stages over a period of years. Does this look familiar? When you are doing a new project, do you just go immediately say, okay, I want to build a new little robot? Do you immediately go set up a factory to build robots, or do you go through maybe an initial study phase? Will people buy this robot? Will it be feasible? So in most projects you go through a feasibility study, maybe a prototype, and then you go to the next stage only if the previous stage is successful. Okay, now here is an example from the book. Okay, so this is about a company that is considering a new project. At time 0, the company, so this is time 0. At time 0, the company, and this actually is to create a robot that automatically makes, TV sets or something like that. So the company spends 500,000 on an initial project. You can call this a research project or an analysis project or a feasibility project. So let's just call it a feasibility project. Okay, so there's a feasibility project that costs 500,000. Okay, at time 0, do you know whether the project will be successful or not? No. You do not know, but if you are smart, what you can do is try and figure out the probability of success and the probability of failure. Okay, so let's say you come up with a probability of success of 0.8, probability of failure of 0.2. So if you determine upfront that so there is a 0.2 probability or a 20% chance that after this feasibility study you will just stop. Why? Because if the feasibility study gives you a result that okay, nobody is going to buy this, you just stop right there. But there is a 80% chance that the feasibility study will give you a favorable result. Then the next thing you do is spend a million. So all these numbers are in thousands. Okay, so you spend $1 million to build a prototype. What does a prototype mean? Yeah, so you build a small working model to make sure you can make it, to show it to your customers, see if they are willing to buy something like this or not. So that is less expensive than building a huge factory to make thousands of these units. So again, will that be a cost? So you incur another cost of $1 million, and then you say, okay, when I build this prototype, I think there is a 60% chance it will be successful and a 40% chance that it will fail. Okay, then if it fails, then your project stops. if it is successful, if the prototype is successful, then what do you think you'll do, Aruj? Yeah, then you will go ahead and make a big plant that you can set up your production facility that makes a whole bunch of this stuff. Okay, so let's say $10,000 is the cost of setting up your whole production facility. Okay, once you set up your production facility, is there any guarantee that this will be a successful product? So there is still no guarantee. Okay, so then there is a 30% chance, so that's 0.3 or 30% chance that the project will be successful, and you will have 18,000, these are actually millions, 18 million, 18 million, 18 million over 3 years. And if it is average success, then there is a 0.4 probability of that, and in that case the net cash flow will be 8 million, 8 million, 8 million. Or after making the production facility you decide that this isn't quite working, in which case you incur a loss of 2 million and stop. Okay, so this is a decision tree. How many people have seen such decision trees before? In what class? In stats. Okay, so this is application of statistics, which is why you've probably seen this in statistics. Okay, so this is your picture. Now what we are going to do is combine statistics with finance, and we are going to say that for every outcome, what is the NPV and what is the probability. So is this one possible? Let's take the very happy scenario first. Okay, this is your happy scenario, right? Okay, so in your happy scenario, what is the probability of the happy scenario? It is from your statistics classes. This is a and. So what do you do with ands in probability? You multiply. So 0. So your happy scenario has a probability of 0.8 into 0.6 into 0.3, which is 0.144. So this is your happiest scenario, which has a probability of 0.144 and NPV of 25,635. How did we come up with this number? Yeah. So imagine, so we are just working in thousands, so forget the thousand. So how did we, I just want you guys to do a little bit of work right now and just write down the formula that will allow us, don't do it on a calculator, just show me the formula for the NPV here. So all we have done for this, just to make sure everybody gets it. So this NPV, for example, was calculated using, so the NPV is equal to minus 500 minus 1000 divided by 1.115 minus 10,000 divided by squared, and then plus 18,000 over the thing cubed, and plus this and plus that. Okay, so we come up with the NPV, we come up with the probability. Then using the same procedure, how did this probability of 0.192 show up?
0.8 and 0.6.
It's 0.8 into 0.6 into 0.4, and the NPV is calculated using the same procedure. So you use the same method to come up with all these numbers. Where did this minus 500 come from? Yeah, so if you immediately spend the 500 and then stop. Okay, so you can get all these numbers. What do you think this column I is telling you? Yeah, it's the probability multiplied by the NPV. So what is the expected value of this? What's the expected value of this project? 275. So that is the expected value of this project. Yeah, मैं आपसे ही पूछने लगा था. What is S? What? Of what? Exactly. So S is the standard deviation of the NPV. So if you plug all these into Excel and ask Excel to give you the standard deviation, what will you get? You should get this standard deviation plus in a IBA exam world, somebody might ask you to calculate the standard deviation using the formulas, but in the real world, you just put it. In the IBA exam, you just learn how to use the standard deviation formula. Yeah, that I'm assuming you know that. You learned that in statistics. All right. Okay, so there are. Okay.